First Majestic says, while silver has had a good rally, let's not forget the basics. The silver to gold mine supply ratio is that there is 7 times more silver being mined than there is gold. There's 7 ounces of silver coming out of the ground right now for each ounce of gold that comes out of the ground, while the gold-silver ratio is trading at 85 to 1. So silver's price is 1/85th of an ounce of gold, or it takes 85 ounces of silver to equal the value of an ounce of gold, when we're digging up only 7 ounces of silver for each ounce of gold, and then the gold, 95% of it, just goes into vaults or is above ground in bars or jewelry or something. It doesn't get disposed of, where the silver, 2/3 of the silver, of those 7 ounces of silver, 2/3 of it gets used up in industry and thrown away. So it's actually a lot more skewed than he's saying. We're still very early. Now, this is the proper way to price silver. How many ounces of gold is it worth? If you do this, you will find out that silver is an absolute screaming bargain, even at $46. It is severely, severely undervalued. Now, Happy Hawaiian says, now that's a gold-silver ratio breakdown. He's got a 3-month chart here of the gold-silver ratio. Remember, the last comment said it was at 83 or 85. It's actually at about 81 while I'm making this video. But here's the last 3 months. I don't know what he's pointing out with this megaphone pattern here, because it doesn't really line up with these candles that well. But this is the breakdown that he's talking about. Now, let's get some perspective on this. This is 3 months. So let's take the long view and really find out what we're doing. So here is a 3-month chart on my website, GoldSilver.com. And this is the breakdown that he's talking about. And it ended up at 81.53. And so that's the breakdown, 3 months of ratio action. But that time frame is 3 months. Let's go to all data here, which takes us back to 1994 or January 1995. And what you see here is that the average is really like below, it's 60 or below. And we're coming off this peak of 100. It was 120 during COVID. This is monthly data. So it's the average for the month. It's not or maybe it's the close of the month, but it's not daily data. If you could see this went over 120, if it was daily data, and this went down to 30. And so if somebody buys silver today at 81, and it drops to a ratio of 20, it was 14 in 1980 when gold and silver peaked. And if it goes down to 20, which I am expecting it to blow right through. I do expect 20, and I am going to be doing this at 20, where you convert some of your silver to gold. But I'm expecting this time. So see, back in 1980, there were huge government stockpiles. We didn't have shortages on the commodities exchange, and well, there was on the commodities exchange, but everywhere else in the world, there were stockpiles of gold and silver. There wasn't a structural deficit where we're using up more silver and throwing it away year after year after year than we are mining, shrinking the stockpiles to critically low levels. There wasn't the levels of deficit spending. There wasn't a currency crisis coming, and I believe there is. And so there wasn't these crisis levels that are going to drive the silver price as people rush into silver more and more and more, and as the media starts covering it more and more and more, when it starts setting these all-time highs, and as more of the mainstream analysts and companies, like you saw TD Securities and you saw Morgan Stanley, they're talking about this now, where they weren't before. As all of this starts to happen and people start to pile into silver, this is going to go down. I do think that somewhere 5,000 is an absolute minimum for gold, but I think that's even silly. I think we're going to be seeing $10,000 gold. Well, at a 20-to-1 ratio, that's $500 silver. And nobody thought that a gold-silver ratio of 14 was achievable. But when the bull market in the 80s, the 70s started, the gold-silver ratio was averaging at around 30, not up at 80, where it's an extreme bargain. Now, if you buy at 80 and you convert to gold at 40, you're getting twice as much gold as you paid for. If it goes to 20 and you convert, that's 4 times more gold than you paid for. And if it does go to 10 and you convert, you're getting 8 times more gold than you paid for. Why would anybody buy gold right now? I mean, I let this dictate to me what I buy, and this is how I ended up with 300 ounces of silver for every ounce of gold that I owned. When it went down here below 50, I wasn't buying any silver. I bought only gold there. But I used to make monthly purchases, and every time it was above 70 or 80, I was buying only silver. And that's why I ended up with so much silver. Now, I just did a video with Alan showing how much cash can come chasing gold and silver. So if you haven't watched this, you really should. But most of you already have, judging by the views. But it's worth reviewing. In there, we updated the final chart from my book. Hi, it's Mike here. Just a quick message. I wanted to welcome the huge number of new visitors to our videos, but point out that less than 15% of our viewers have subscribed to this channel and hit the notification bell. We're heading into some turbulent times, so if you don't want to miss any updates, make sure you enable notifications. And thank you as always for clicking the thumbs up button. One more thing. At GoldSilver.com, we've been providing top-notch educational content for over 20 years. If you'd like to help us continue this mission, we'd be honored to be your precious metals dealer. It's a win-win. At the moment, you can get up to $2,000 in bonus silver by ordering from us. Check out GoldSilver.com in the link below. Thanks, and now back to the video. Worth reviewing. In there, we updated the final chart from my book, and this line was when the book was published. And so all of these unused credit card line, money market funds, and currency plus demand deposits had exploded from 16 to over $20 trillion. This is currency that can come chasing gold and silver instantly. Within 24 hours, it can be buying gold and silver. However, that's just the United States. The stockpiles of gold and silver and the people that can buy it, this is global, not just the United States. So we've got to not be so U.S.-centric here, and we've got to look at the entire globe. And so PM Bug responded to this chart and our video that said that over 20 trillion could come chasing it. He said, let's say a very conservative 1%, just 1% of 20 trillion is 200 billion. 200 billion at $45 a troy ounce represents 4.444 billion troy ounces, or 138,237.7 metric tons of silver. There isn't enough liquid free float in global free float vault stock plus mine production to meet that level of demand. No, there isn't, not at 45, maybe at 145. But this 20 trillion is US only. In that same video, Alan showed this chart, and so this is globally. So if you measure currency, we were at, in the book, it was 7.5 trillion, and it jumped up to about 10 trillion in the United States. But when you add all the other currency on the planet, you're talking about 80 trillion there. And then 125 trillion of stocks, and 145 trillion in bonds. Morgan Stanley says of which you should liquidate 50% of it and transfer that into gold so that you've got a 60-20-20 portfolio. And anyway, this plus this plus this plus this ends up at $350 trillion. And so 1% of that is 3.5 trillion, not 200 billion. And so we're talking a whole nother level of thing happening here. The explosion that we are going to see in precious metals, $10,000 gold is almost like a silly low price. I said 5,000 earlier, but that's 5,000 is absurd. That's not even on the table. $10,000 gold minimum is like a destiny. Now, gold can go up, and then to save currencies around the planet, they can come up with a new world monetary system based on gold and peg it, and it'll stop. Silver will go into a super spike and then probably come back, but silver is still going to give you this giant leverage. So let's say, 1% of each of these, that's 3.5 trillion, let alone this new mix of 20% bonds, 20% precious metals, and 60% stocks, which would mean liquidating half of the bonds. This is an absolute flood. Now, when I first started buying silver, this is a chart of 2002 and 2003. I started buying gold back in October. It was $315 an ounce at spot price when I made my first purchase. I made my silver purchase in April at about $4.38 an ounce, and I made another purchase at $4.50 roughly. And back then, at $4.50, the coin shops were empty. I walked in, I was the only person in there. I was in there for a few hours. The only person there. And so it sort of looked like this. At $4.50, there was nobody. Move the decimal 1 point over to today, and at $45, there's a trickle. There's a few people. I wasn't a precious metals dealer then. I was just an investor, a buyer, just starting. And now I am a precious metals dealer, so I know how much sales is happening, and it is just a tiny little trickle. But let's move the decimal one more time because of the news media constantly pummeling these people with, it really will be month after month at first, and then week after week, and then day after day. They're going to be hearing about silver. And people will come flooding in, and that is what is required for this super spike to happen. Silver is mostly an industrial metal most of the time, but there are these rare moments in history where it becomes the safe haven investment. It becomes money once again. There's monetary demand to preserve your purchasing power, your wealth. And so how does the powers that be, the commodities exchange and all of the government, how do they control this? How do they try to keep this from happening? Well, what they do is they raise margin requirements. They did this a bunch of times in the late 70s and the first January of 1980, and they lost control of it. They could changing margin requirements constantly, that and then position limits, and then finally liquidation orders only for silver. So Nick Laird of Gold Charts R Us sent me this. The CME raises gold margins by 6.3% and silver by 6.7%. Now, what happens when you raise margin requirements? This is on futures that we're talking about. So you've got the commodities exchange trading all these futures contracts, paper silver and gold that does not exist. They just make it up, and it's highly leveraged. So there might be, at times, there might be more than 300 ounces of paper silver floating around for each real ounce that's in the vaults that's deliverable. But when they raise this by 6.7%, you either have to come up with that cash if you're leveraged out to the max on your margin, or you've got to liquidate that much of your position to get within their limits. And so this time, though, they're going to lose control of it just like they did last time. The last time they lost control of it, and it exploded in the final months of 79 and the first month of 1980. So this is the commodities exchange. So Bald Guy Money says COMEX trying to hammer down the price of silver. So here we go. Here it is one more time. I want to thank you for watching. We'll see you next time.
Invest and earn up to $2,000 in bonus silver at GoldSilver.com. It's easy. Step 1. Open any GoldSilver storage account excluding IRAs. Step 2. Purchase your precious metals. Step 3. Get up to $2,000 in bonus silver dropped straight into your vault. Visit GoldSilver.com/free silver to claim your silver.